If you're buying a home in 2025, you've probably heard people talk about FHA loans and conventional loans. But what's the real difference between them? And which one is better for you? This is one of the most common questions that I get from first-time home buyers. And the truth is, it's not about which loan is better overall, it's about which one fits you best. So today, I'm breaking down FHA versus conventional loans in simple terms, explaining how each one works and giving you the pros and cons so that you can make the best choice for your situation. Hello everyone, welcome back to my channel. I'm Audrey Rozier, a licensed realtor in Maryland, DC, and Virginia. Now, just a quick disclaimer, this video does not reflect my personal opinion in any capacity. It is not legal advice and is not intended to steer or discourage anyone from any specific location. Always consult with a qualified real estate agent to discuss your personal housing needs. With that being said, let's get into the video. Now let's start with the basics. Both FHA and conventional loans are popular financing options, especially for first-time home buyers. They both can help you buy a home with less than 20% down, but they're backed by different organizations and can come with different requirements. Now, FHA loans are insured by the Federal Housing Administration. They were created to make homeownership accessible to buyers with smaller down payments or limited credit history. Conventional loans, on the other hand, are not backed by the government. They're offered by private lenders and typically follow guidelines set by Fannie Mae and Freddie Mac. Now, at a glance, FHA tends to be more flexible for credit and down payment, while conventional loans reward stronger financial profiles. Let's break down each one a little deeper. Now, if you're a first-time home buyer, FHA loans are often where you start, and for good reason. They're designed to help people who might not qualify for traditional financing just yet. Here's what you need to know. The minimum down payment is 3.5% if your credit score is 580 or higher. If your score is between 500 and 579, you can still qualify, but you'll need 10% down. FHA also allows higher debt-to-income ratios than most conventional loans, which helps if you have student loans or other obligations. The program also allows gift funds for your down payment, meaning a family member can help you with the purchase. Now, for the trade-offs. FHA loans require mortgage insurance premiums, aka MIP, both an upfront fee and an annual premium that's built into your monthly payment. Now, that upfront fee is 1.75% of the loan amount, and the annual premium usually ranges between 0.55 and 0.85%, depending on your down payment and loan term. The key thing to remember is that FHA mortgage insurance stays for the life of the loan unless you refinance into a conventional loan later. Now, conventional loans are funded by private lenders and tend to have more flexibility once you meet their minimum standards. The minimum down payment is 3% for qualified first-time home buyers, and credit score requirements are higher, typically 620 or above. And the stronger your credit, the better your rate and terms. One of the biggest differences with conventional loans versus FHA loans is that the private mortgage insurance can be removed once you reach 20% equity in the home. That means that you're not paying it forever. And in some cases, you can even avoid it up front by putting down 20%. Conventional loans also offer higher loan limits in most areas, which can make a huge difference if you're buying in high-cost markets like Montgomery County, Arlington, or even the DC metro area. However, conventional loans are stricter about debt-to-income ratios and past credit issues. So if you've had a recent bankruptcy, foreclosure, or a major late payment, you may need to wait a little longer to qualify. So, how do you decide between the two? Let's go side by side. If you have a lower credit score, FHA may be the better option. The government insurance allows lenders to approve buyers that might otherwise be considered higher risk. If your credit is strong, a conventional loan usually saves you more money long term because you can remove the mortgage insurance. If you have a small down payment, both options work, but conventional loans often come out ahead if you can put down 5% or more because the mortgage insurance cost drops faster. If you're buying a home that needs work, FHA can be a great option, especially with their 203K renovation loan, which allows you to roll repair costs into the mortgage. On the other hand, though, if you're buying a condo, you'll need to check to make sure that the complex is FHA approved. A lot of them aren't, and that can limit your options. Now let's talk about interest rates and cost. FHA loans typically offer lower interest rates than conventional loans, especially for buyers with average or below average credit. That's because the government guarantee reduces lender risk. However, once you factor in the mortgage insurance, the overall monthly cost can be similar or even higher than a conventional loan. Conventional loans, while they may have slightly higher interest rates, tend to cost less in the long run because you can drop PMI and refinance without paying upfront mortgage insurance again. So when comparing, don't just look at the rate, look at the total monthly payment and the long-term cost over 5, 10, or even 15 years. Another major difference between FHA and conventional loans is how they handle appraisals and property condition. FHA appraisals are more detailed and must confirm that the property meets minimum health and safety standards. That means if the home has peeling paint, missing handrails, or outdated systems, the appraiser may flag it for repair before the loan can close. This protects buyers, but also can slow down the process if the seller isn't prepared to make repairs. Conventional appraisals, on the other hand, focus primarily on value rather than condition, so they're generally less strict. And if you're buying a home that's move-in ready, this typically won't matter much. But if you're buying something older or you need flexibility with repairs, this could be the deciding factor between loan types. Now let's talk about closing costs. FHA and conventional loans both have closing costs, which typically range between 2% and 4% of the purchase price. FHA allows sellers to contribute up to 6% of the home's price towards your closing costs, while conventional loans usually cap it at 3% if you're putting less than 10% down. Now, this might not sound like a big difference, but it can matter if you're tight on cash or in a buyer's market where sellers are willing to help. Now, here's something I wish every buyer understood. The best loan isn't the one with the lowest interest rate. It's the one that fits your financial situation, timeline, and goals. For example, if you plan to stay in your home for 5 years, then upgrade, an FHA loan might make sense because it's easier to qualify for upfront. Now, if you plan to stay long-term and have strong credit, a conventional loan will likely save you more over time. That's why I always encourage buyers to talk with a lender who can show both options side by side, total payments, closing costs, and long-term projections before making a decision. Let's look at an example to make this real. Say you're buying a $400,000 home with 3.5% down as a down payment on an FHA loan, and you have a 6.25% interest rate. Your total monthly payment, including mortgage insurance, might be around $2,900. Now, the same home with a 5% down payment conventional loan at a 6.5% interest rate might come out to roughly $2,800 after factoring in PMI. They're close, but over time, once you remove the PMI on the conventional loan, your monthly cost does go down while the FHA stays the same. So the right choice depends on how long you plan to keep the loan and how quickly you can build equity. For buyers that are watching this who want to take action, if your credit is improving or you've been working on paying down debt, get approved for both loan types. It doesn't hurt to compare. Your lender can run the numbers side by side and show you exactly what your payments would look like. And if you're not quite ready, this is also a good time to review your credit report, set a savings plan, and learn which programs fit your future goals. The earlier that you prepare, the more confident you're going to be when it's time to make a move. And if you're planning to buy here in Maryland, DC, or Virginia, there are also a lot of local programs that pair with these loan types, like first-time buyer grants or tax credits that can reduce your out-of-pocket costs even further. The key is pairing the right loan with the right strategy. If you'd like a general overview of what it's like to live here in Maryland and explore the types of resources available for buyers, you can download my relocation guide using the link in the description. It's not loan-specific, but it's a great place to start. And if you'd like to connect with a trusted professional, whether that's here locally or in another state, you can schedule a call or fill out the contact form on my website, and I'll make sure that you're connected to someone who can help. That's all I have for today's video. I appreciate you so much for taking the time to watch, and I will see you on the next one.